Well, good morning and welcome to today's webinar. And on FS Club today, we're thrilled to have Tom Tayler and Steve Waygood, both from Aviva Investors, and both, I think, for those of us in the climate change and finance space, well known. Steve and Tom have volunteered to talk about harnessing markets to deliver Paris. And one of the great things today is the ability to dial in. In this case, Steve's coming in from Beaconsfield and Tom is coming in from York. So yes, we are not incurring as many carbon miles as we could. So hopefully we're doing our little bit today, which is one of the great things about this new tech. Now you'll know me, I am Michael Mainelli, I'm one of the directors as Yen, and it really is a privilege to be able to introduce all of these webinars, and I can only do so thanks to the tolerance, generosity, and widespread interests of our various partners, many of whom are here today, and many of whom I think will be interested in what Steve and Tom are going to be talking about, particularly with reference to the G20, but I'll leave that to them, and we'll be getting on with that. Now, the format today is one known to many frequent listeners, and that's that my job is to get out of the way as quickly as possible and hand over to our experts. Steve and Tom will be presenting for about 20 minutes, and then we have about 20 minutes for Q&A. And of course, it's the Q&A that's very important here. So during the question and answer session, please do use the GoToWebinar question facility. It's got several advantages, not least it'll record your email and your question, and I will be sending all your questions, comments, and observations on to Steve and Tom. Your email will be attached to them so you can get in touch directly with them that way. That's the easiest. Secondly, I might point out that this is being recorded. The recording will go up in approximately 2 working days, so sometime about midday on Thursday. So over the coronation bank holiday weekend, you can share with family and friends and watch on the popcorn and put all the other stuff on the television to one side. Thirdly, the slides. The slides are not available as they usually are ahead of time, but they will be posted again on Thursday with the video recording. So with all the housekeeping, I think, out of the way, if I may, we're now going to switch over to Tom's machine. And I would like to say, both Steve and Tom, the floor is very much yours. Thank you.
Michael, thank you so much. That was an exceptionally kind introduction, and thank you for the invitation to come back to these seminars. I remember vividly our last a few years ago, and it was an excellent experience. I know very interactive, so Tom and I will take just 20 minutes to take you through the slides that, as you say, will be shared. The most important point to say at the outset, though, is why is Aviva, one of the world's biggest insurance companies, and Aviva Investors, where Tom and I both work, why are they encouraging us to do this work? And it's because we believe the climate change represents still the world's biggest market failure. It's also a failure of global governance and a regulatory failure and a government failure. So we know the current implied temperature change of the London markets will drive a level of physical risk into the global economy that is simply more than I think the insurance business model will be able to support. I'm getting a little bit of feedback on the earphones. I wonder if that's something that, Peter, you might be able to deal with. So the implied temperature change, we mentioned this in the 2 documents that you've got here in front of you. Sorry, the last slide, I think, Tom. These 2 documents are available online, so if you want to do a screen grab and get the links for future reference, effectively you don't need to take notes, you just need to listen, because between the Act Now report, which we did in the run-up to COP27, and the AIQ, the Aviva Investors Quarterly magazine, which argues for why investors need to engage at the system level, macro level, not just individually with companies. Many of you online working in investment institutions will be now well used to micro engagement, engaging with companies. We're now arguing that these issues are so big, we should be engaging with the system, with governments, and use the sovereign debt opportunity as a window to engage. So that's a little bit about why Aviva's given us permission. We think it's an existential crisis and will collapse the insurance business model if climate change continues unmitigated. And on this slide now, the next one, which shows the policy and action, where are we today? I touched on this already. The implied temperature change of most markets is well north of 3 degrees. It's only when you start turning up at the COP, UNFCCC COP meetings, that it looks like it's getting, the debate gets anywhere near 1.5. And honestly, I find it absurd. I've been going to the UNFCCC meetings since COP6. I haven't done all of them by any means, but I find it absurd that they're still talking about 1.5 degrees when the real economy is currently in London 3.4 degrees. That's what's being capitalised if you burn all the proven and probable reserves. Now then, obviously the targets get you further, and then the pledges get you further still, and one has to be incredibly optimistic to be now in the scope of delivering Paris. Now, we all know that, and this is a closing window, but just to kind of flag one on the science and the urgency of acting on climate change, there are various thermometers that we have put together that talk about the impact on food, natural environment, water, cities, infrastructure, and so on. The one that keeps me awake at night is top right-hand corner. The percentage of the population at 3 degrees that will be exposed to more than 20 days a year of deadly heat, the human body will, in other words, start to shut down. We're talking about 3/4, roughly, of the world's population either having to live inside in air conditioning for those days, and let's hope the energy systems continue to function to power those aircon units at these temperature changes or these temperatures, or we're seeing mass migration, which will lead, we're not just talking about the physical risk of climate change and flood, fire, famine, we're also talking about the geopolitical risk of climate change. And with the level of individuals that could be migrating as a consequence of a 3 degree shift, it's unconscionable, but nevertheless, where we're currently heading. Let me repeat that, where we're currently heading, north of 3 degrees by the end of the century. So the point I'm making with the UN process is I find it somewhat absurd that they continue to focus on whether 1.5 degrees is alive, when it's clearly 3.5, with cataclysmic consequences, which is currently being capitalized in the real economy and by the financial system. So we have to change it. There is no option. The next slide takes you through the reality of climate change. Most of you will be well aware of just how many parts per million of CO2 we now have in the atmosphere. It's 277 parts per million when Aviva was first created in 1696. It's gone up enormously, and obviously it's anthropogenic now. The science is now generally accepted, and we're seeing that level of sea level rise and ocean acidification. So these, as an insurance business, we are the front line of exposure to these risks. And if our insurance business model tips over, given how much banking needs insurance to be underwriting the real world, then of course banking isn't far behind. Mortgage markets, of course, need home insurance, and it was just 8% of the US mortgage market that led to the global financial crisis in 08-09. We're talking about all mortgage markets everywhere, inexorably getting worse. So sorry to be so doom-mongery about this, but I'm being blunt and direct about the honest reality of where we're heading. And I'm not mincing words, even though I know if a journalist was among us now, they'd consider this sensationalist, but it's the reality. So that's where we are, unfortunately, with climate change. Question is, how do we stop it? Because it is not too late. And that is the wonderful news. There is a window of opportunity, a very small one, but a window nonetheless, to stop that reality from unfurling. And on the next slide, and as I hand it to Tom, we talk about the trajectory of a crisis. And Tom, the floor is yours.
Thanks, Steve. So as Steve touched on, with the current trajectory, the trajectory that we know we need to shift, we move from something that has been increasingly recognized by central banks, by finance ministries as a financial stability threat, to something that actually is a financial collapse threat. And this is something we talk about in the first of those reports that were on was on the first slide in the Act Now report. We see a cascading crisis where we move from that scientific basis that Steve described to hit some of those worsening physical impacts. We're already seeing time and time again records being broken in terms of ocean temperature, that linking to increasingly extreme weather events, heat waves that we're currently seeing in Southeast Asia, in parts of Southern Europe, even in April and into May. And one thing that we're seeing is too much focus, in our view, on transition risk, important though that is, so the risk to enterprise value, to economic growth caused by the transition, and not enough focus on the end of century physical risk from the temperature trajectory that we're heading towards. And as Steve mentioned, if those temperature rises aren't limited, if we don't change direction really quite rapidly, and as Steve also mentioned, the hope is from the pace at which transitions can happen, following an exponential transition, as we've seen time and time again from industrial transitions. But if we don't change that, then we risk crossing tipping points that send us into different system states that mean that in terms of finance, and particularly in our report, we focus on insurance as the investment manager of a global insurer. Insurance would either cease to be something that insurers want to underwrite because you're increasingly underwriting certainties, which doesn't fit with the underwriting model, or the cost of the insurance becomes unaffordable for those to whom it's offered. And Steve talked about the threat to mortgage markets, but equally there are threats to project finance. You can't build anything without insurance. You can't run companies or infrastructure without insurance. You can't move things around the world in terms of trade without insurance. And because of the way that insurance is critical to banking, to loans, to issuing equity and debt into the capital markets, and as well as being an investment that insurers are often listed and invested in, all those intersecting factors mean that you could see the financial system not go through a crisis, as we've seen before, most recently in 2008, but actually a collapse. And what we argue, and what particularly in the AIQ macro stewardship document that was on that first slide, is that finance has a critical and outsized role in changing this trajectory. And we've described this as a self-reinforcing triple helix. This builds on the ambition loop work of We Mean Business, and argues that companies are increasingly starting to lean into the transition and showing what is possible, moving ahead of that policy environment that was shown on the climate action tracker thermometer on a previous slide. And then that creates space for more ambitious government policy as they see the direction that the real economy is taking. And on both of those constituencies, finance has a huge role. So we can use our influence with companies to encourage them to transition and mitigate their risks, but we must also increasingly advocate with governments for the enabling environment we need as financial institutions to deliver our own net zero and decarbonisation ambitions, but also those of the companies in the real economy that we underwrite, that we invest in, and that we lend to. And so that role of finance reinforcing the calls for government policy and the calls for ambition from companies is a critical way in which finance can speed up this critical change of direction. And one of the ways that we think we need to do this is harnessing the trajectory that's happening in terms of transition plans. So in the UK, we have the Transition Plan Taskforce, which has put out guidance for best-in-class transition plans. Last year, there was also guidance prepared by GFAN, so the Glasgow Financial Alliance for Net Zero, both for financial institutions and for the real economy. And the FSB has added transition planning into its work programme for this year. But what we argue, particularly in terms of what's needed in transition plans, is they're not just needed from the private sector, important though that is, because a transition plan on how you're going to deliver a 2050, or in the case of Aviva Investors 2040 net zero ambition, you need to also set out what you're going to do right now and over the short term. And that's where transition plans come in. But we don't just need them from corporates and financial institutions. We need them from governments so that we have a policy trajectory for how we're going to deliver on the ambitions that are set out in NDCs. But we also critically need them to create an enabling environment in terms of the regulation and supervision of finance. So the international financial architecture, which wasn't designed, wasn't designed at all, but certainly wasn't designed to deal with this century's preeminent challenge, which is the transition, needs to work out how it's going to play its role in delivering and supporting the global transition. Steve, back to you.
Thank you, Tom. It just struck me, could I have the earlier slide, the last slide back again? Just I'll do the segue to this slide in a second. I just wanted to, for the audience, just amplify and echo one or two of the points that you were making. I've been on the Financial Stability Board Task Force for climate-related financial disclosure since 2015. It's done amazing things, but very little to do with sovereign debt. I want to amplify that point. The GFANZ opportunity, we helped Mark Carney build GFANZ and were a founder signatory when it was created. And our group chief executive co-chairs the Transition Plan Task Force. Now, the TCFD couldn't have transition plans at the heart of it because it was held back by the US government at the time under Trump. But transition plans are, of course, they have to be delivered. If we can make sure that transition plans at the corporate level talk about what government policy is needed, you start to kick that triple helix off that Tom referred to. We need transition plans to set out at the corporate level what do the companies need from governments, and then we need investors to work with companies to engage with government to shape that global governance system that is actually fit for purpose when it comes to this colossal transition where all sectors everywhere, all at once, need to transition. And then the way that then feeds into the international financial architecture, Tom, thank you for the next slide, is as well as companies and investors having transition plans, we think governments and their agencies need them too. And that needs to be choreographed, ideally by one of the multilateral organizations. When I say choreographed, I don't mean directed, that would clearly be implausible, but a space where people can come together for a debate on how we're going to steward a broad transition. But at the heart of this slide, let me go back to the real economy for a second, those two unreadable words at the very heart of the Venn diagram of the real economy. Every company has a bank account. Most companies have some form of insurance, and many of them have come to the markets for capital. Those three pillars of finance are kept separate in the way they're regulated, normally at the national level by the central banks and their regulators that are often independent, but still nevertheless within the finance ministry. And it's those finance ministries that then work with standard setters on an international basis, and then associations of regulators, again on an international basis. We don't have global regulators per se, but IOSCO brings a global forum. The International Organization for Security Commissioners is a global forum for national regulators to try and coordinate their work. As we all know, we still haven't managed to do that with accounting standards. There's still two main ones, but this is the framework that has evolved. And the point that we're about to make, the crucial point, is that all of that system evolved. All of it now needs to be harnessed to manage a smooth and just transition to net zero by 2050. And it's the G7 and the G20 that issue the mandates of those organizations. And it is at that level now that we have key sustainable finance moments, the multilateral moments coming up. If you think of that entire onion needing to be transitioned, the opportunities that are coming up, the key moments for change on the next slide, with a Bonn conference, a finance track meeting, you can see how Abu Dhabi Sustainability Week, of course we've got COP28 coming up later this year as well. These are just largely in the next 12 to 18 months. Major moments that if we can choreograph them together, for example, the Macron Bridgetown Summit in June, how do we make sure that that feeds into the G20 summit that can then can start to reissue mandates for this financial architecture, or reshape the mandates, I should say. The ideal that we need is the UAE stock take at COP28 to take stock, not just of the overseas development assistance, the ODA, the 100 billion, but from a finance perspective, the UAE needs to take stock of the entire international financial architecture to see where it's aligned with or undermining the transition, and how do you harness it. And we're hopeful that the G20 this year will enable UAE COP28 to take stock of this financial architecture and then feed it back into Brazil's G20 under Lula, where hopefully Russia-Ukraine will have come to an end, and both Russia and China are then able to come to the table at the G20 and agree big ideas, big changes. So in terms of geopolitical alignment for action, the next slide, we've got the transition from Japan, G7, India's G20, UAE, COP28, through to Italy, Brazil, Europe, on to then Canada, South Africa, Brazil, again for COP30. And as you can see, Brazil is appearing a number of times already. We're expecting perhaps Australia to have COP31. And these countries, under the current regimes, get the imperative of climate change and the need to harness markets and money. And wonderfully, next July is the 80th anniversary of the Bretton Woods system, which created EBRD, World Bank, to some extent IMF. And these organizations, we now know all of these institutions have a role. Many of them are beginning to explore what that is. And so on the final slide, I think, Tom, if we perhaps leave this slide, the next slide on while we then take the Q&A, and if perhaps, Tommy, in the next 20, 30 seconds, you could just kind of bring us home with the key calls to action.
Yeah, thank you, Steve. So at the end of our Act Now report, we set out this this call to action. So we, as Steve highlighted, on the outside of that onion diagram, if you like, of the international financial architecture, we have these international regulators. Sorry, we have these international groups of regulators who oversee and down through into international ministries oversee finance, and we think that they need to be reset, reformed to really focus on how they're going to create the enabling environment for this transition. So we need each of them to create a roadmap or transition plan for the net zero transition. That involves review of their mandates or constitutions. Although there is good work going on relating to financial stability, relating to disclosure, climate change, nature loss, inequality, other huge market failures that threaten long-term global growth and financial stability are not part of the mandates of these institutions, and yet these are the challenges that they're having to face. We think that annual reporting is necessary, arguably into something like the finance track of the G20 and the G7, but as well bringing in a more global picture and not just limiting the reporting to those countries. And then we need a global transition plan. If we've got all different parts of the system working at different paces, we're not going to move markets in a systemic way that we need. So creating and stewarding a global transition plan is critical. And as Steve mentioned, we see the opportunity of 2024 representing the 80th anniversary of the iconic Bretton Woods Conference as a means to bring this together and create an iconic moment at which the beginnings of this plan could be created. Michael, I think we'll hand back to you for some Q&A.
Well, wonderful. Thanks so much for outlining this. Firstly, folks, Peter has actually found the Act Now, and it's in the chat room, so you can click on it and read along with this discussion. Really, just to get cracking, Steve and Tom, you mentioned the need to have these transition roadmaps and all that, and in your paper, you put forward a whole host of things: the OECD, the Financial Stability Board, the UN, etc. It seems quite ambitious to kind of say, well, all these institutions ought to do something. What would be the core group of people you really need to get hold of?
Ideally, G7 finance ministers first, then enable a G20 conversation on this stuff, which is honest and realistic and talks about pace, that then enables the UNFCCC, which we've been talking to a lot over many years, to do the stock take, and then feeds it back into Lula for the finance track, again, of the G20, to then next year, perhaps even at Bretton Woods, have the finance ministers convened there in New Hampshire. That would be de minimis path to huge change, and it is huge change that we need here to harness markets. So that would be ideal geopolitics. We are endeavoring to reach out, and all of the organizations that you mentioned just now, Michael, and the ones you saw on the slide, we've written to them and engaged with them in to exactly this end. Whether they do or not is another matter.
Okay. Well, looking at that now, I'd like people to take away from today a specific or two. Could you give us, a really hard thing? I mean, roadmaps are, just plans, and politicians are full of plans that they what genuine structural change do you want to see to the architecture?
Tom, would you like me to, or I see you leaning in? Go for it.
Well, no, I suppose, yeah, I think, as we mentioned, one of the key things is that the architecture isn't designed to deal with what we currently have on our plate today. Each time that the architecture gets reformed, it tends to be to avoid repeating the previous crisis. So last time out, the Financial Stability Board evolved out of previous structures to look at how, in particular, we can avoid a 2008 style credit crunch, and a lot of the current prudential regulation was sort of formed out of 2008. But rather than waiting for and reacting to the next crisis, which could easily be a collapse, we need to ex ante now think about what system do we need to allow finance to play a huge role in facilitating the transition. At the moment, the financial system globally is supporting, due to particularly short-termism, continuing to support the status quo, and it's slowing the transition down, where actually it could be a huge force for speeding the transition up if regulation was moved. So that's why we think the review of the mandates, the review of the work programs is necessary. We did a bit of looking at the mandates in the input we gave to the global stocktake earlier in the year, and there isn't any reference to any of these issues in there, even though it's being implied in, particularly through financial stability. So we think that's really important. Our experience, for example, at Aviva, of having a ambitious net zero commitment is that then gives people wanting to work on this stuff within the institution a hook to say, well, I need to do this because it's linked to our long-term ambition. And at the moment, it's that key sort of building block isn't there within these institutions, even for the excellent people within the institutions who are trying to do more work on this.
Okay.
Can I add to that briefly, Michael? Just there are 5 things, I think, 5 specifics. So in addition to what Tom said, 1, listing rules. IOSCO needs to make sure listing rules require TCFD disclosures and ideally transition plans. 2, the financial stability regime still promotes flows of insurance money into old economy securities, fossil fuel, auto, chem, etc. So we are actually reducing the cost of capital of most of the sectors that are undermining our business model. That is not prudent. That's the second. 3, price stability mandates of central banks. They are caught between the need for cheap oil today and the need to move away from oil now for tomorrow. So they're caught at the moment in the pincers. 4, the market integrity definition of fund managers. We have to maintain the integrity of the market, not front running, not mis-selling, not insider trading. Market integrity also means structural integrity. So I think this kind of advocacy, macro stewardship, should be a requirement on all fund managers to maintain market integrity. And then finally, 5, the default investment management agreements and the default benchmarks set between asset owners and asset managers need to evolve rapidly to consider carbon return on capital employed and help finance emerging market, developed economy, NDC aligned investments so that the system itself can be protected. So I think that's a completely different lens on financial stability. Those are 5 very tangible suggestions. There are probably dozens of others, but that's why we need a stocktake.
They are indeed, in fact, good tangible suggestions, and I think I'll go away, thinking about those. So that's the kind of thing I was after. So thank you so much. And it leads interestingly on to a question from you, Purser. Your diagrams, and that as a systems theorist, I might say what you're actually talking about is the need to speed up the system and to make the decisions more rapidly, and thus the investments, etc. There's a lot of speed in your talk. Hugh is saying, can financial institutions really break away from quarterly and annual return targets and obligations?
Well, I think one of the things is that, yeah, so simple answer is yes. Take pension funds. So 50 trillion of pension money in the global economy. pension trustees have an obligation not to prefer one class of beneficiaries over another. So if you've got an open pension scheme that has both someone retiring in the next 6 months and someone who's 6 months into their pension saving journey, you've got one person retiring in 2023 and one perhaps in 2070. And pension trustees can't prefer the needs of the person retiring today over the needs of the person retiring in 2070. At the moment, we're probably investing in a way that fundamentally undermines the retirement of the person who would retire in 2070. So there is a need to stretch those horizons, but there are already structures in place that do stretch them out. If we think about the obligations that the asset owners in particular have that are inherently long term.
Good. Now we've got an interesting double point here. It's about the relationship of your program with ESG, and I could surmise a few things, but Angel Gaviero wonders, do you think that the ESG acronym has overcomplicated things? Should not GHGs, greenhouse gases, within the E be prioritized versus everything else, given the carbon budget limitations? So that's one angle here. And then Richard Parler is asking, international governance will be need to be more than financial. There's nothing similar on the wider environment or biodiversity, for example. So how can the good parts of financial service governance be transmitted to other sectors vital to the transition? So I guess attention here really, should the C in ESG or just break away, or should we be trying to do this across the board?
Tom, I'll get this. I think, and then I'll hand it back to you. Has ESG overcomplicated? The abbreviation overcomplicated the dynamic. There is no question that there are lots of social and governance issues that are very, very material to companies and need to be considered by asset managers over their investment time horizons, no question. And other environmental issues too, beyond climate change. But there is nothing that presents a greater existential crisis to our system in the ESG spectrum. Nothing great. Climate change is the single biggest threat. So I do believe that a lot of people have stopped seeing the wood for the trees, and we now need to focus our minds on some of these major existential challenges. So yes, we do need to focus on this. The physical risks being created by climate change. Governance needs to be harnessed, and that's what we've argued. We need to harness corporate governance and then intertwine it with country governance so that we govern the global commons in a better way with these transition frameworks. And that's really my answer to both questions, because there is we obviously have the Convention on Biodiversity, CBD, there was the Kunming Montreal meeting last December. Our group chief executive was there, so was our Canadian chief executive. We were very pleased to see Article 21C replicated now in the CBD, and there'll be a meeting next year in Turkey, I think it's Antalya, where there'll be another CBD. So there is some kind of framework, but as the questioner implies, the UN does not govern the system. It is a convener for a conversation. It's the nation states that make pledges that they will do something that have to be held to account. And our main argument is the institutions that can hold governments to account for delivering these commitments are finance institutions. We lend money to these governments. Why is stewardship only about the corporate environment? I know we own the equity and we get to vote at the AGM, and legally we're the principal, they're our agent, and that is different on sovereign debt. But the thought that we have no obligation or opportunity is quite wrong. And we must engage now at the sovereign level, raising our game. And as you say, Michael, we do need to speed up the system and changes to the system. And Donella Meadows would say we need to change the paradigm. That is the most important of all. And that's what we're trying to do, change the ESG paradigm to engage at the level of the macro economy, macro stewardship, not just micro.
Well, yeah, indeed. And in fact, in terms of holding sovereign feet to the fire, as you know, Ziad is quite a proponent of policy performance bonds or sovereign sustainability linked bonds. I'm quite proud of our work, particularly Uruguay coffee. But moving on, there's some interesting stuff here as well. Graham Elliott muses for a bit. He goes, where insurance is deemed mandatory, will law and practice need to change to make it discretionary, just so as to allow businesses to be carried on? Currently, unavailability of required insurance can destroy businesses. Now, he's musing there. Nikki Holzhausen, though, kicks in with a comment that comes off of that in a way. She absolutely agrees with you guys that coordination is needed across governments, insurance, banking. But she wonders, what do you think? Is there a place for a global disaster insurance fund?
Yes, there is. Tom, do you want? I know we've talked about this from kind of planetary, haven't we? Do you want to?
Well, so maybe if I comment on the first part, and then you can move to the planetary part, Steve. I think one of the things is we already have an insurance gap. We already have increasing losses. So just over $1/3 of a trillion of disaster-related losses in 2021, which is the most recent figures that there are. But a huge amount of those were not insured losses. And so the kind of musing, as you put it, in terms of will mandatory insurance have to become discretionary? Well, that could see a huge increase in risk to both individuals and to companies if mandatory insurance isn't in place. So what we're arguing is not that actually insurance cover needs to be withdrawn, and we're already seeing reinsurers and insurers avoiding cover in certain sectors where they deem risk to be uncommercial for them or undesirable for their businesses. We actually need to find a way to allow insurance to continue to function. And that means that we need to deal with some of these systemic risks that actually threaten the operation of the business model. Steve, I'll let you take the point on the sort of disaster recovery insurance.
Thank you. Obviously, at COP28, this question came up in a very big way. We've got flood re in the UK. I think the reinsurance business model could be extended, but there will come a point at which there's just too much risk in the system, and that too will collapse. So I do think we need to be thinking about Planet Re, that kind of scale. What could World Bank, IMF do to help create that? We've got loss and damage being the big conversation that I think that relates to. There's also the Sendai framework under the UN Disaster Risk Recovery Framework, which has obviously got a meeting coming up in New York in May, in fact later this month, so in about 3 weeks. We've got, on Graham's question, I think he's right to suggest that, but bear in mind that banks need it to know that their collateral is valuable, not a liability. So it's not just whether the government policy requires insurance, it's whether banks need it. And if the insurance isn't there, pretty much every credit rating starts to be downgraded. That means the collateral becomes less valuable. That means we see a run. So this is, you know, it's not just about enabling business to continue by letting insurance step to one side. Banks need it, and credit ratings require it. So and that's just the corporate side. Just think about what goes on in the sovereign space, where all EMDE countries will be open to downgrade because of the physical risk, making it more expensive for them to raise capital to adapt. So it's not just a Minsky moment, a rapid repricing of securities that will lead to a financial stability moment. There are many other fundamental challenges to the market's integrity that will lead to financial stability crises. But you know, this it's not too late. We can stop it, and that's the whole point here. What can we do together, all of us here online? How can we engage with G7, G20, COP to stop this happening? They need to be moving faster, as you say, Michael.
Well, speaking of speed, Chris Gleadle, who's quite a systems theorist or circular, and I don't mean that in a nasty way, Chris, circular thinker. Chris is interested in this. For the actions that you take, how do you decide upon the boundary and action sequence to ensure the speediest positive outcomes on the complex interplay that you've got between all these independent multiple effects of climate change? And he expands a little bit on it. You know, how far beyond a single example, for example, emissions, biodiversity, land use change, and that's all these independent actions and the sequence of them, delivering projects in an order where the environmental return on investment is delivered quicker between one project and another. So there's a sequencing issue. I think as well, you know, there's this phrase which is quite tired, but I loved it when I heard it, you know, boiling the ocean. You know, what are you not going to do?
Well, the ocean is being boiled. That's the problem. we need to stop that. I'm a big fan of circular economic thinking too. Tom, I'm sure you'll have views on this. We don't have yet a clearly articulated, because there are so many changes across so many sectors and across whole entire economies. The boundary and action sequence is clearly defined. We're not pretending to have those yet. What we're saying is we need a way of running companies at the micro level that adds up to a macro policy framework being promoted by companies that need the transition and investors that know that we're existentially exposed if there is no transition. We believe that every year a transition plan can incrementally play out to governments what policy is needed, and then investors can encourage governments to take that step. So this is more of a governance structure than detailed action plans with boundaries and sequences. So I think those questions, those conversations, the trade-offs, what's optimal, that needs to be, there surely needs to be a created space globally where these conversations can actually happen. And the OECD was built to marshal the resources of the Marshall Plan, which it did in the 50s. Well, it's now the world's most expensive think tank. Why don't we harness the resources of the OECD to do more of this stuff too? Tom, did you want to add anything on that?
The thing I'd say in terms of that systems theory, systems change, the system is incredibly good at absorbing incremental change and continuing in its current form, which is why you need to take a step back and you need to think in that. How do you change the paradigm? How do you change the system? How do you change mindsets as well as rules in terms of that? And what we have concluded is that to change systems, you need to think about leverage points, going back to the Donella Meadows reference that Steve gave, and you need a lever. And if there is $500 trillion worth of capital in the financial system, then that's an enormous lever, and one that actually is much bigger than any single government or even group of governments. And so, given that it's in our enlightened self-interest to make this transition happen faster, to allow our business models to continue, we need to bring that lever together.
Good. We're coming close to the end of time, so I ask you to be quite terse on a few of these. Firstly, Toby Stanley says, an interesting session, but do you have any thoughts on carbon capture and sequestration, like direct air capture in particular?
It needs to happen at scale, many orders of magnitude than it is at the moment, and the technology needs to be made to work and funded by governments as a public good. We need, ideally, a tax on fossil fuels to fund that.
Okay. Clive Bullen is asking, what direct actions can financial institutions take now? And that's aligned with a comment from Sophie, who thanks you for your thoughts, particularly those 5 core thoughts, Steve. Those are very helpful. But on a micro level, as each organization can really deal with what is within their hand, what tips do you have for them implementing an effective transition plan? So, and particularly in the case of Aviva, where you've set this hard deadline and people are responding that is our goal. Any quick thoughts for financial institutions, people working within them?
So I would say, looking downwards and upwards, engage with companies and ensure that they're producing transition plans that set out the enabling policy environment that they need from their governments and regulators to deliver on their transition ambitions. And then looking upwards, they engage with regulators, with policymakers, and at the global level, collectively as well as individually, to again ask for the enabling policy environment that they need to deliver the transition.
Okay, and a very quick one. You admire Bretton Woods, and I wish we had more time to go into why you see that as a good example. But about Bretton Woods too, Angel Gaviera wants to know, could an IMF or World Bank massive program of SDR collateralized AAA ultra long-term bonds help to catalyze at scale private investment to public use?
Yes, it could. Unfortunately, though, we're maximum at $500 billion, and we need about 4 to 6 trillion per annum. So it's good, but not good enough. Bridgetown we love. We need more than it, though.
Good. Well, gents, we've sadly come to the end of time, but a few points I might make in particular on this, folks. There's a lot to read. It was posted in the chat room, and we will be posting them on the website with the recording of the links to the 2 documents that Steve and Tom referenced. Secondly, if this conversation is of interest to you, we are hosting Steve and Tom on the 23rd of March here in London at a location yet to be determined, but it will be in the City of London. and it will be a conference very much about how we renovate this financial architecture. And I believe that Steve and Tom are anxious to get to, Tom, I think you said something about we need to explain to governments where the transition plans that we need are being hampered by their policy choices, and need to do that. And the idea is really on the 23rd to start the process over the next few months of getting the financial sector behind this program that Steve and Tom are elucidating, so that in fact such a conference could potentially be held with the G20 next year. And finally, just a pointer, Steve and Tom are happy to reach out to anybody, and it's quite clear that many of the sponsors of FS Club, I won't pick on any in particular, but the various nations and cities that are behind the various COPs, not least, if you're part of the G20, please do feel free to get hold of me or directly, as you know, Steve and Tom, to start engaging, because there's a lot of work to do if we're going to have a Bretton Woods 2 next year. So with that, if I may, I'd like to thank our sponsors who are so tolerant in allowing us to range widely across technology, economics, and finance. And if this new financial architecture doesn't cover all of that, I'd be surprised. I'd like to thank the audience, as ever. You've been fantastic today. Actually, I think I said March. My apology. I meant 23rd of May. Thank you very much to Richard Parler for pointing that out to me. Sorry, 23rd of May, a Tuesday. And that'll just be before the 24th of May, which is the Net Zero Delivery Summit. We have a number of events, as ever. Please just go to the website. But quite interestingly, on the 11th of May, we have one of our BizTech Kwewa chats where we try and get Europe together with Asia. This one is going to be developing emissions trading schemes, not least the emergence of China, July, nearly 2 years ago, is pointing multinationals to the need to actually handle global trading and not just within a single ETS system. So that'll be fascinating, I think, for many of you on this call. Well, with that, if I may, the biggest thanks of all must certainly go to both Tom and Steve for giving us such a challenging webinar today. And I really appreciate the fact that they've come to share it. And please come and chat with them on the 23rd of May with us. Thank you.